Okay, so we're back, chapter 8, and see if this thing wants to start working now. Okay, so when we deal with what? When we deal with depreciation, and we're going to see that we're going to have what? We're going to have the cost, which are all expenditures necessary to acquire an asset and make it ready for its intended use. We will have to then take that and divide it by its useful life. That will give us our annual depreciation. But before we divide it by the useful life, we will subtract off the salvage value, right? And we did this early on in some of the early chapters, and so that's why I'm saying that this should not be that difficult for us to remember what we're supposed to do with depreciation, okay? So we come over and we give you the information for this truck that they're going to be purchasing, and the cost of the truck is $13,000. The expected useful life is 1,000. Estimated useful life is what? 5 years, and the estimated useful life in miles is 100,000 miles. Now we're going to learn some different methods here for calculating our depreciation, and we're going to learn straight line first. Now straight line is pretty much what we had learned in some of those earlier chapters when we were sort of starting out practicing with depreciation a little bit, in that straight line is going to be the $13,000 purchase price of this asset minus what? Minus the $1,000 salvage value gives us a depreciable base of how much? $12,000. We'll divide that by what? By the 5 years, and that is going to give us annual depreciation of what? Okay, forget it then. Don't worry about it. Just know that it's some number. Okay? So what happens? I'm going to go ahead. You got a number for me? How much? $2,400 a year. Yeah, a year on that. So we'll do what? We'll debit depreciation expense for $2,400 and credit the accumulated depreciation for $2,400, right? That's our annual depreciation. Okay, that straight line. We're going to use the estimated use in miles. We're going to use the miles, and we'll look at that. And then we're going to talk towards the end about something called the declining balance. Declining balance is an accelerated version of straight line, and we'll see how that works towards the end of our discussion. Okay? Okay, now, of course, when we purchase the equipment, we do what? We debit the equipment for $13,000. We credit the cash, don't we? Okay, and that equipment account, we're just going to leave it alone year after year, and we're going to record the depreciation against what? Against the accumulated depreciation account. Accumulated depreciation is a contra asset account against equipment, isn't it? Okay. Okay, good. So we go ahead and start to take a look at this, and let's just take a look at the number of companies that use these different methods. Straight line is the most commonly used method because it is the easiest to use. There are other methods that get used much more infrequently because they are a little bit difficult. Declining balance is used a little bit because there's a tax advantage. Units of activity is probably our most accurate method, but because of the additional record keeping that's associated with that, most companies just use straight line as their best estimate as to what the amount of depreciation will be. So let's talk about straight line. And notice here on this slide, it's the same exact thing that I wrote on the previous slide. The $13,000 cost minus what? Salvage value gives me my depreciable base. I take the depreciable base, divide that by the number of years. That gives me the annual depreciation, doesn't it? In this example, $2,400, right? Okay. Okay, good. Now, I kind of don't like exactly how they showed this 20%. I know why they did it, but sometimes I have to explain to students that 1 divided by 5 is what? What's 1 divided by 5? 0.2 or 20%. Okay, so multiplying something by 20% is the same as dividing it by 5, isn't it? Right? Okay, good. You guys are a little sharper. Some groups I'll spend the rest of the class explaining why that's the case, okay? But as long as we're good on that, then we should be good then to realize that what? 12,000 times 20% gives me 2,400 in year 1, 2,400 in year 2, 2,400 in year 3, 2,400 in year, and so on, right? Okay, straight line, taking the same amount each year. Notice the book value does what? It is what I paid for the asset, the 13,000 minus, and for year 1, 13,000 minus 2,400. You see down here at the bottom gives me a $10,600 book value, right? In year 2, my accumulated depreciation is what? 4,800. So if I'm looking at this for year 2, 13,000 minus what? Now 4,800, right? Gives me what? Gives me the $8,200 of carrying value, book value. So the carrying value is always what? Always the original cost of the asset minus the accumulated depreciation. That's my carrying value, my book value, right? Okay. Okay, good. Now, to sort of help with that, it's a little hard to see, but I wrote this on the board. I think we did something like this, and I wrote it on the board like 5 times. I was going nuts, writing it 5 different times. Remember that? Okay, and so what happens? Not for this same problem, but cost is 13, expected salvage value is 1,000, estimated useful life is 5 years, annual depreciation is 13,000 minus 1,000, gives me my depreciable base of 12,000 divided by the 5 years, 2,400 annual depreciation expense, right? And if you look, I take 2,400 as my depreciation expense in year 1, year 2, year 3, year 4, year 5. The depreciation expense is the same every year, isn't it? Yes. Right? Okay. Now, what happens? On my balance sheet, year 1, when I first purchased the asset, it's what? Its carrying value is exactly what I paid for it, right? But by the end of year 1, I'm showing accumulated depreciation of what? 2,400, right? Because I credited it that first time for 2,400. Accumulated depreciation is 2,400. Carrying value is what? 10,600, right? Second year, I do what? Make the same journal entry. I'm going to do that every year. Debit depreciation expense 2,400. That gets reported on the income statement. Now my accumulated depreciation is 4,800. Carrying value is 8,200, right? Then the third year, same journal entry. Isn't it fun to be an accountant? Depreciation expense is what? 2,400 on the income statement. Another 2,400 in the accumulated depreciation. Now the accumulated depreciation is 7,200, right? Year 3. Year 4, same journal entry, depreciation expenses, 2,400 on the income statement for year 4. I put another 2,400 accumulated depreciation. Now the accumulated depreciation is 9,600. The carrying value of the asset is 3,400. Year 5, debited depreciation expense 2,400, credit the accumulated depreciation 2,400. Depreciation expense on the income statement is 2,400. The accumulated depreciation is now 12,000. The salvage value on the asset is $1,000, which is how we set up our estimate. So at the end of the 5th year, we're pretty much showing what we were thinking we could sell that asset for, right? That's it. Straight line. Okay? Okay, good. Now, depreciation is an estimate. Just like this thing in this rear view mirror, objects in mirror are closer than they appear. So that mirror is an estimate too, isn't it? So you don't sit there and say, well, wait a minute, that can't be. How can that mirror say that? It's got to be exact. No, it's an estimate, isn't it? And that mirror is warning you of such. Well, in our financial statements, we would be required to warn the users that there are estimates in this financial statement. The amounts that we put down as to our collectability of accounts receivable, it's an estimate. The amount that we're putting down for the depreciation, it's an estimate, isn't it? Okay, so the financial statements are full of estimate. Depreciation is the classic example of that, and FASB requires, GAAP requires that we put a footnote in there that explains that and warns the people of that, right? Okay, okay. Now, what happens? Eventually we sell the truck, don't we? And let's say we sell that truck, we get rid of it, and say we sell the truck at the end of year 5 for $1,000. Well, we're going to get $1,000 cash. We're going to debit. The accumulated depreciation was up to $12,000, wasn't it? So we'll debit the accumulated depreciation to eliminate that from our books because the truck is going, isn't it? We're getting rid of the truck, so we'll get rid of the accumulated depreciation. We credit the truck. Perfect, right? It worked out perfectly, didn't it? Okay, now that's usually not the case. Usually you'll sell the truck for more or less than its carrying value, right? Because you're not going to have a perfect estimate. So what happens? If we sell it for $2,000, we debit the cash for $2,000. We credit the truck for $13,000. We're getting rid of it. We debit the accumulated depreciation for $12,000 because we're getting rid of the truck. We'll get rid of the depreciation, right? Do we need a debit or a credit to make this journal entry balance? We needed a credit. We credit what? We credit that as a gain and report it on the income statement in year 5. It's sort of a catch-up, isn't it? And that, hey, we were taking a little bit too much depreciation all that time, and so now we're showing you a gain of, $1,000 that catches us up. Is that gain operating or non-operating? Good. That's a non-operating. We're not in the business of selling our equipment, are we? Okay, and so that's going to be a gain. It's going to be shown as non-operating. What if the truck sold for $500? Who's got the journal entry for me, huh? We'd have a loss of $500. Good. You want to give me a journal entry for that? Sold it for $500 cash. Good. Debit cash 500. Good. Debit the, I'm not going to put debits and credits. That's why they say put them on the left and the right so we don't have to do that every time, right? So accumulated depreciation is going to be what? For $12,000 debit? Okay, good. What else? Debit or credit? Credit the truck, right? No, I know you meant credit, right? Truck. For what, 13? Okay, good. And we need what? A debit to make this journal entry balance? Yeah. And that debit is a loss, you're saying? Yeah. So it'll be a loss of $4,000. Huh? A loss of $4,000. Oh, wait, no. You already told me it's a loss of $500, right? To make the journal entry balance? Yeah. Right? Did we get it? Okay, C. Okay. Debit the cash. Debit the loss. Very good. Debit the accumulated depreciation. Credit the truck asset. And that's a loss in year 5. That is a non-operating loss. That's sort of a catch-up because what? I should have really been taking more depreciation all that time, shouldn't have I? But it was an estimate. I did my best, right? Okay. Okay, good. So that's straight line. Straight line's a piece of cake, isn't it? Question? Oh, yeah. Oh, yes, it is, right? Okay. Units of activity, also very simple. Okay. And that we're going to do what? We're going to sit here and we're going to take our depreciable cost, divide that by what? By our total units of activity, which is the number of miles we're going to drive this truck, right? So if the truck cost us, well, it cost us 13, but we subtract off the $1,000 salvage value, so we have our depreciable base of 12. Divide that by 100,000, that's 12 cents a mile. Okay? If we drive the truck 15,000 miles, our depreciation in that, we'll assume that's the first year, is 1,800. Pretty smart depreciation method, isn't it? If we drive the truck 0, what's the depreciation? 0 or some, huh? 0. Or sometimes, they'll have like just an automatic amount of depreciation because what? Because the wind blows and the rain falls and everything turns to dust eventually, right? And so what happened? They'll go ahead and they maybe will take, a small amount annually no matter what. But just assume for our understanding purposes here that what? If we don't drive it any miles, we take what? We take 0 depreciation, right? Okay, so this is pretty smart, isn't it? Okay, Wade, don't you think this is more accurate? Because we don't use the truck much, we don't take much depreciation. We use the truck a lot, we take a lot of depreciation, right? What's the problem with this approach? You're thinking, well, why do so little companies do this then? If it's so much more accurate than straight line. I mean, if I don't drive that truck at all, I shouldn't even depreciate it, should I? I mean, it's sitting there in a garage, packed in whatever they pack trucks in to keep them fresh, right? And so mothballs or whatever it is. Okay, so why should we take any depreciation on that truck if we haven't used it? Everybody should do this, shouldn't they? Why doesn't FASB require them to do this better method? What's the problem with this? Yes, sir. You got to convert it. Very good. And worse yet, you got to keep track of this. So now we've got what? I mean, you say, well, it's just one truck, John. Well, what if it's a fleet of 52,000 trucks that we're going to have to sit there and what? Require somebody to go and put down the mileage, etc., right? Now, they are getting more sophisticated with this in that they now probably have wireless odometers that can feed into what? Feed into some reporting system. And so maybe as time goes on, it will be easier and easier for companies to use a unit of production type thing. But it does require an additional record keeping, doesn't it? Now we're incurring the cost of a wireless odometer just to what? To potentially give us a slightly better estimate here, right? Okay, so that's why the percentage was so small. But this is what? This is a more accurate way than the straight line, isn't it? Okay, but notice it works the same exact way. We take our depreciation expense, we take our accumulated depreciation. It just varies from year to year depending on how much we use that truck, right? And then we do not depreciate below salvage value. So notice that what? Once we've taken the $1,000, we stop right there, even if we continue to drive the truck. You do not depreciate below salvage value.
So like something like looking at book value, I think like Kelly Blue Book, that's just a company.
That's market value.
That's market value.
That's market value. But we keep it at the lower of cost or market. Now, if the Blue Book says that it's worth $5, we have to write it down to $5. Okay, that's book value. Market value is the Blue Book. Okay, so if the Blue Book said that it was $500, we should write it down, and we continue to write it down as the market value comes down. But that's kind of beyond the scope of what we're getting into right here. Okay. Okay, good. Is that the rats are coming again? Okay, now we can also have something called declining balance. Declining balance takes a larger percentage of the depreciation than does straight line. So we're going to have some multiple of straight line when we use declining balance. We'll have some multiple straight line when you use declining balance. Could be double, could be triple, could be 1.5 the straight line. The most common one that we talk about in 101A here is going to be double declining balance. So it's going to be double the straight line. Okay? So what happens? Remember, 1 divided by 5 is what? 20%. What is double 20%? 40%. So double declining balance would be double the straight line. Instead of being 20 in this case, it would be what? 40%, right? What if it was a 4-year life? What's 1 divided by 4? 4-year life would be 25%. If we wanted double, that'd be what? Double declining balance would be what? Would be 50%. With me so far? So instead of using 20 in this example, we're going to use what? 40% for our annual depreciation. Now, this is the one thing that's a little bit weird about double declining balance. Okay, ready? With double declining balance, we don't use the salvage value in our calculation. We simply take the depreciation on the original cost each period. With me so far? However, we kind of keep that salvage value off to the side and we keep looking at it. And once we have depreciated down to the full salvage value, we stop depreciating. So even though we don't use it in the calculation, we're what? We're aware of it and we're watching that salvage value and making sure we don't depreciate below the salvage value. Okay? So let's just go ahead and let's take a look at our double declining balance. And so we have what? We have this 13,000, which was what we paid for it, times what? Times 40%. That gives me what? 5,200 of depreciation. I have my accumulated depreciation then is 5,200. So the book value, and I'm not sure I described that quite right to you when I said it a minute ago. The book value is now 13,000 minus the accumulated depreciation of 5,200 or 7,800, right? We take that what? We take that 13,000 minus the 5,200 equals 7,800. That's the remaining book value for year 2. Our depreciation is 7,800 times 40% or 3,120, isn't it? Okay, we take that what? We take that 3,120 and we subtract it from the previous carrying value of 7,800 minus the 3,120 leaves me a new carrying value of what? 4,680. I take the 4,680 times 40%. That gives me a depreciation. Why don't we just go ahead and see that 4,680 times 40% equals what? Huh? Oh, there it is right there. Hello. 1872. Okay, good. 1872. I take what? I take 4,680 minus what? 1872. That gives me what? 2,808. Right? Okay. I take that 2,808. I multiply that by what? 40%. That gives me 1123. Good. I take the 1123 and I do what? I subtract that off of the 2,808. That gives me what? 1685. I take that 1685 and I multiply that times 40% and I get what? No. Don't read the numbers off the table to me now. 1685 times 40% is what? 674, you say? 674? 674. 674. Good. So I take that what? I take that 674 off of 1685. 1685 minus what? 674 gives me 1,000 what? 1,011. Like that? Okay, look. In year 6, and they just jumped the gun because they said, I'm not going to worry about taking $11 depreciation in year 6. Because in year 6, I can tell you, we're not going to take 1,011 times 40%. That's going to be $400, isn't it? roughly. And I can't take $400 depreciation in that next year because then I would go below the salvage value. I mean, not 4,000, but 400. I'd go below the salvage value, wouldn't I? So in year 6, just doing this in an exact manner, in year 6, we'd have depreciation expense of $11, wouldn't we? In year 6, because we can't depreciate below salvage value. Our carrying value was 1,011. We can't take 40% of that. That's going to bring it down 600, isn't it? So in year 6, we would just take $11. But the book decided, hey, I ain't taking $11 in year 6. Okay, that's stupid. I'm going to do what? I'm just going to round up my depreciation, that extra $11 in year 5, right? They went ahead and took it in year 5. But the takeaway is you do not depreciate below salvage value, right? Okay, so declining balance, usually double declining balance, we do what? Take the straight line, we double it, right? Okay, we double the straight line, we take that and we take that against the original cost of it for year 1, don't we? That gives us our depreciation for year 1. That gives us our accumulated depreciation for at the end of year 1. We take the what? The original cost minus accumulated depreciation. That gives us the carrying value that goes forward to what? Year 2. We take 40% of that. We take the depreciation for year 2 off of that 7,800. That gives us the what? That gives us the carrying value going into year 3, right? We take that new carrying value times the 20%. That gives me the what? Depreciation for year 3. Take that off of the previous year's carrying value. That gives me the carrying value going into year 4, right? Okay. Question? Okay, good. So let's go ahead and let's take a look at the quiz questions now for year. What year are we in now? I mean, what chapter are we in now? What year is it? Is it 1980 again? Okay, so let's go ahead and let's close this thing. I'm going to say don't save. I don't know. Did I record that? I don't think I did I? It does? Where? How come the little clock isn't counting? Oh, it is. Okay. Okay. All right. So let's go ahead and close that now. No, I have the files I need. But I do need to reopen chapter 8 because the computer crashed on us. So come on. And we're looking for quizzes, right? Chapter 8. I better turn this computer off at the end of the night. I think it's because it runs 24/7 and it's probably just having trouble finding itself right now. No, I don't want this. Okay, so let's go ahead and let's take a look at some of these. Okay. And let's go ahead and put it back in tablet mode. Okay, and let's do this. Okay, so A company purchased office equipment for $40,000, estimated salvage value of $8,000 at the end of its 4-year useful life. The constant percentage to be applied against book value each year if double declining balance is used. And what do we do? We take the straight line. Straight line is what? 1 divided by 4, isn't it? Isn't that straight line? So straight line would have been 25%, and if I'm using double declining balance, that's double the straight line, or what? 50%. Okay, good. A company purchased factory equipment for $35,000. If estimated that the equipment will have a salvage value of $35,000 and estimated useful life of 5 years, if the company uses double declining balance, the amount of annual depreciation recorded for the going to take me all the way into the second year, right? Okay, so can we do the first year? Give me the, 350,000. Okay, go ahead. What's the percentage? Well, it's a 5-year life. 1 divided by 5 is what? Is 20%, and they're using what kind of double declining? So I have to double the straight line, don't I? So it's 40%? Okay, good. So 350,000 times what? What about the salvage value? Don't I have to subtract off the salvage value? I do. For double declining balance, I don't subtract off the salvage value. I simply don't depreciate below the salvage value, right? I'm just aware of it. Remember, in the example we just looked at, I kept doing that same, whatever it was, 13,000, and then I took the remaining amount, right? First I took 13,000 the first year, I should say. So 350,000 times what percent? Times 0.4 gives me how much for year 1? Huh? 140,000? Okay, good. What do you want me to do with that? Huh? You want me to take that 140 off of the previous year's balance? 140,000. That gives me what? Remaining balance of 210,000. Okay, good. And that's now going to constitute my year 2 base, isn't it? Right? So how much do I take off of that? 40%, 0.40 off of 210,000 is what? 84,000. Is that my depreciation then for what? For the second year? 84,000. Isn't this fun? Don't you wish I would have shown this to you last week, so when the kids came to your house and said trick or treat, you could have said, "Come on in, kids, let me show you something." And you could have showed them the depreciation, right? Now you know why no one comes to my house. Okay. Okay. I know how to get rid of them trick-or-treaters. Okay. Year number 3 now, right? Okay. Okay, good. So we take a look at number 3, and we say a factory machine was purchased. Any question on that last one? No? A factory machine was purchased for $125,000. It was estimated that it would have a salvage value of $25,000 at the end of its 5-year useful life. It was also estimated the machine could run 40,000 hours in those 5 years. The company ran the machine for 4,000 actual hours. If the company uses units of activity, what would the depreciation be? How much did they pay for the machine? 125,000. Good. And salvage value is how much? Do I worry about it for units of production? Yes, I do. I don't worry about it for declining balance. I use it for straight line and for units of production, right? Okay, so I got to take off that 25,000. So my depreciable base here is, even I can do that one in my head. It's 100,000, isn't it? Okay, good. I take that 100,000 and do what? If my engineers tell me that this thing should run 40,000 hours, I'm going to use that number, right? So since it's supposed to run for 40,000 hours, that means I'm going to use up how much per hour on that machine? $2.50 an hour? $2.50 an hour, right? 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 How many hours did they drive it? Did they use it? They used it for 4,000 hours. So the depreciation should be 10,000. Look, 125,000 when I paid for the machine. Salvage value is what? 25,000, so I have a depreciable base of $100,000, don't I? If I'm going to run that thing 40,000 hours, that's 250 per hour, right? And so since in year one I used the machine for 4,000 hours, that's $10,000 depreciation, right? What if in year two I run the machine for 5,000 hours? 5,000 times what? Times the 250 gives me what? 12,500 for year two? And so on. What if I drive the machine 0 in year three? Drive the machine, use the machine, whatever, for 0 hours in year three. No depreciation, right? Unless they had like a base depreciation that they were taking on it. That's beyond the scope of our discussion. Okay? Okay, good. October 1st, whole company places a new asset into service. The cost of the asset is 80. The estimated useful life is 5. The salvage value is 20. At the end of its useful life, what is the depreciation expense for 2014, the year they bought it? Who wants to set that up? Set it up for me. It's straight line. 80,000 is my purchase. Good. Minus 20,000 salvage value. Good. Gives me 60,000. Depreciable base is 60,000. Now what? Huh? 20% for the 5-year life? Okay, do you mind if I divide it by 5? Okay, that gives me what? Huh? 12,000. Is that the answer? No, 12,000 is not the answer. Why not? Huh? No, it has a 5-year life. When did I put that asset into use? October 1st. So did I use it for an entire year in 2014? Did I use it for an entire year? Did I use it for an entire year in 2014? I did not. I used it for how many of the 12 months? Huh? 3 of the 12 months? So I should take that 12,000 and multiply it by 3/12, shouldn't I? Now do I get the answer? Huh? Oh, wait, it's not 3/12. October, November, December. Yeah, 3 months. Okay, sorry. So do I get the 3,000 now? Okay. Can we have done this mathematically another way? The way I do these is I would have taken the 60,000 and I would have done what? Multiplied that by what? By the oh yeah, I guess I could have done it this way. I could do it the way we did here, the times of 3/12. Yeah, that's the way I like to do it. Times of 3/12. Never mind. I like to do it that way. You could have done that. I was thinking that, but then I thought that's gonna be more trouble than it's worth. Times 3/60ths. Could have I done that and got the same number? Times 3/60ths. 60 months and 5 years. Okay? The takeaway here, guys, is what? Be careful. It is easy to mess up in a problem where we're giving you the asset being in use partially through the year, and you're going to fall into the trap of taking the full month depreciation. And trust me, when they write these test banks, that's no accident that they put the full year depreciation first, because you get all excited and you think this is an easy question, and you don't pay attention, and there's your 12,000, right?
Can you do also the 60,000 times 3 over 12 and then multiply by 20%?
Commutative law of multiplication says you can. I don't like that. That's not intuitive to me. Because I'm really taking the depreciation. The 20% is really the depreciation on the 60,000, isn't it? The dividing it by 5 or the multiplying it by 20%, right? So I'm not quite sure when you're taking 60,000, you're multiplying that by 3/12. What is that first step meaning to you? That number that you come out with is a nothing number. When you take it times the 20% first, that first number that comes out is a full year's depreciation, and then you turn it into what? Then you turn it into a partial year depreciation. The logic just stands up and says, thank you for showing me to everyone, right? Whereas when you do it the other way, people sit there and go, what? Oh, okay. Whereas this way, it just all sort of flows, right? Okay, but yeah, if you want to do it that way, mathematics says that commutative law of mathematics says you can multiply the numbers in any order, and you'll get the same answer. Yeah. Okay. If you don't get the same answer, throw that calculator away. Okay. All right. Okay, how about this one? Straight line depreciation. Buy the equipment what? April 1st for 80,000, right? Salvage value is what? 10,000. That gives me depreciable base of 70,000. Good. What's the life of this equipment? 10 years. I like to go ahead and divide it by 10 years. That gives me what? 7,000 for the first year? Is that the answer? No, I have to multiply that times what? Times all of April, all of May, all of June, all of July, all of August, all of September, October, November, December. 9 months. 9 months. I'm telling you guys, do not figure out the months in your head. Step away from the problem and count the numbers on your fingers. How many months? 9 months. I promise you, I don't know what it is about us human beings when we're counting months in our head like that, we mess them up every time. So that's what?
1,250.
That's a trick question, you said?
Oh, no, because I was thinking someone told me, like you said, the 10-year life, and then like you were talking about earlier, how they'll do the full year.
Right. They always give you the full year, right? They're setting you up for that. So you were cussing out the test bank? Yeah, right? How dare they? Okay. Okay, good. How about double declining balance here now? Isn't it the same facts, but it's double declining balance now? Okay. So what do you want me to do with this? What's the life of this asset? 5 years. 1 divided by 5 equals what? 20%. And we're doing what? We're doing, this is not In-N-Out Burger. It's just double. No, double. Okay, so it's, okay, well, that's the first double. There's no second double. So it's 40%. Okay. You can call it double double if you want to, though. Okay. And I'll take some animal style with that, please. Okay. So what happens? We're sitting here and we got 40%. Okay. So 40%. What do you want me to do with that 40%? Huh? Multiply it times the 80,000, you say? Okay. And that gives me what? 32,000 of depreciation, right? Okay. What are they looking for? The book value on this property? Did I use this thing the whole year? In that first year? I only used it for what? 3 of the 12 months in the year, so my depreciation for year 1 is what? Huh? 8,000 is my depreciation for year 1, right? So, right? So I take the 80,000 minus what? 8,000 of depreciation for year 1, so I'm going to start year 2 with what? 72,000, right? Is that the answer to this question? Who wants to give me year two's depreciation on this thing now? I got 72,000. That was my remaining book value at the end of year 1. What do you want to do for year 2? 43,000. Set it up for me. Uh huh. Times 40% again. Good. 28,800 of depreciation for year 2, and then you're saying you're going to take that 28,800 off of the 28,800 off of 72, 43,000 what? 200? 43,200, right? Good. And now you're set for year 3. You could take 40% of year 3, right? And you just keep doing that, but do not depreciate below what? Salvage value. You're capped at the salvage value. Okay, good. A company sells a plant asset with an original cost of what? 240,000 for 80,000. The accumulated depreciation had a balance of 96,000 after the current year's depreciation of 24,000 had been recorded. The company should recognize. Now we do have two A's there. The first one's clearly not the right answer. So it's going to be what? 240,000 is the original cost, and the what? Accumulated depreciation is 96,000, isn't it? So the book value of that asset is how much? Huh? 144,000, you say? Okay. And I sold this thing for how much? 80,000, didn't I? So I sold it for less than its book value, right? What's the difference? 64,000? That's a $64,000 what? Loss because I sold it for less than its book value, right? Right? Who wants to give me the journal entry on that? Debit cash for what? 80,000, good. Debit loss for 64. Do you mind if we do the loss last? I'll put that debit. You're right, but I want to do that last. Go ahead, give me another debit. No, I'm going to do that last. Don't give me that lost. I'm going to do the long line for the loss last. Is there another debit in here?
Depreciation.
Good. I'm going to debit the accumulated depreciation for what? 96,000? Is that the accumulated depreciation? Got to get rid of that. Okay, how about the credit? Have to credit the equipment for what? 240,000 because I'm getting rid of that equipment, right? Okay, good. Now I need a number to make this journal entry balance, which is what? Which is the loss, which you wanted to debit before and I wouldn't let you. You want to do it now? You want to come up and do it? So I'm going to debit the loss for what? 64,000. Okay, I wanted to wait to do it so that we can see that you could have solved that same problem using a journal entry, right? Because you know you got to bring in the cash, you know you got to get rid of the accumulated depreciation, you know you got to get rid of the equipment, and then you just need the gain or loss to make that journal entry balance, right? Or you could have done it this way. Okay, all right, good. How about number 9? Equipment that costs what? 120. Had accumulated depreciation of what? 100,000.
200. Yeah.
Oh, sorry, 210. Okay, I'm gonna just write it down here. 210 minus what? Accumulated depreciation of 100,000. Good. That gives me a book value of 110, and I sold the equipment for what? Oh, great. Now these people. Oh no. Okay, I see. Okay, go ahead. 110,000 was the book value, and I disposed it for how much?
90.
Cash of 90,000. So I sold it for what? For less than its book value, didn't I? So I have a loss of what? 20,000 here? Okay, good. Who wants to give me the journal entry for this?
Debit cash for 90,000.
Debit cash for 90,000. Good.
Accumulated depreciation of 100,000.
I'm not going to credit accumulated depreciation. Accumulated depreciation is credited as I depreciate that asset. If I'm trying to get that accumulated depreciation off the books, I have to do what?
Debit.
Debit the accumulated depreciation for what?
100,000.
100,000. Okay, good. What else?
Loss of 20,000.
Debit the loss for 20,000.
Yes.
Okay.
Credit. Credit equipment.
Credit the equipment for 210.
210.
Right? Okay. Now I'm showing you that because what? I mean, what if I made this all journal entries, right? Then you'd have to be able to do the journal entry for it. So there's no credit to the equipment for 110. The credit to equipment is for what? 210, isn't it? Right? There's no credit to accumulated depreciation. It is what?
A debit.
A debit to accumulated depreciation, right? Right?
Yep.
Okay. That's it?
Yes.
Perfect. Look at that. Okay, now, um, at this point, we are going to get out of here, so see you later.